As I said, this call will specifically focus in on doing an in-depth analysis, walk over first, second, and third underlying dynamics. First being more macroeconomics, like macroeconomic data and predictions in accordance to that monetary policy. And then we'll move over towards individual assets fundamentals, and then we'll finish up with individual assets flows, sentiment, and future predictions. Sounds good? Hopefully it sounds good at least. Let's just pretty much get started. So the first thing we're going to focus on is just the individual first underlying dynamics, second underlying dynamics, and third underlying dynamics. So we're going to pretty much go an overview of the geo and macroeconomic concepts. Going to go and focus on the key individual analysis in accordance to supply demand factors of these individual assets, like the second underlying dynamics. And then we're pretty much going to focus in on the individual assets, sentiment, and flows. Now, first of all, just simply focusing in on the CPI, you can see that it's currently up from previous 2.9, and this latest September report, we came with a CPI of around 3%, as we previously said, right? Now, our future forecast has been for the foreseeable future for the inflation in the US to go down, and we are focused in on, of course, shelter, which has gone down dramatically to, I think, around 3.6% year on year, which is historically low if you look at the year on year 5-year average. Like if you do a C-score of the 5-year average, you can see that shelters has gone down dramatically. What has essentially kept this inflation persistently high is, of course, electricity and food costs, and that's something we're gonna go into. However, ultimately we are looking for electricity costs, like electricity and energy, but also other such as food, etc., to actually go down, which will cause the underlying inflation to continue down simultaneously as we see shelter, etc., continue down as well. Shelter inflation going down as well, thanks to mortgage rates and all that. Now, this is pretty much the indicator. Hopefully I've checked that out. I'm pretty much right now gonna send this. This is essentially what I uploaded yesterday in accordance to another video labeled essentially inflation. So hopefully you've watched that. That's an inflation video specifically, so please go in and check that out. Now, personally, this is the sort of indicator I uploaded. I also fixed our algo locking indicator. I'm just gonna send this to you guys right here, so you can see this is essentially the advanced inflation indicator. This is the one I have right now, and I'm currently showing you. This simply goes through all the individual inflation measurements as well as the interest rate, which essentially shows you all the individual different types of inflation measurements, but not there, and some forward indicators, I may say. So of course we have majority of them not being forecasters, meaning forwarded assets to, or not forward assets, but like forwarded indicators, like projecting what inflation may very well go towards in the future. However, rather majority of them is just the measurements like CPI, core CPI, PCE, core PCE, trimmed CPI, trimmed PCE, PPI, but you have money supply as a proxy, as it says right here. Now it just shows you essentially the velocity of money, which of course correlates into if you're above higher than 10%, a warning signal to a higher inflation. Now, reminders here, as we talked about during that inflation call, that does not necessarily mean that when we're going above 10%, we're gonna have inflation. But you can see whenever it has gone over 10%, like for example here, you can see this is the 10% mark. You can see that we usually see lagging to inflation here, and this is what pretty much we're seeing right here. So you can see the individual colors right here correlates to what the individual lines represent. So you can see CPI year over year is this orange line, while core CPI is this yellow line right here. Now, difference between CPI and core CPI, and whenever you see core, is that you get this volatility, the volatility gone, meaning that you get these more volatile aspects of CPI. So normal CPI is pretty much all of these above, and then core CPI, I'll show everything, so don't worry. I'm just gonna finish this and then we'll take questions afterwards. So normal CPI is just all of these above. Now core CPI is pretty much all of this except for the more volatile consumer things, consumer goods and services. Okay, so it excludes energy and electricity, but also food and food away from home and natural gas, etc., etc. So it excludes some things, and that's core. And the same thing goes for core PCE. It's just a core PCE rather than the more volatile goods and services that's gone. Since all of these are just different measurements of essentially same thing, which is inflation. So all these are just trying to capture where inflation is in the economy and how it looks. And so you can see CPI is ultimately the highest one right now. And trimmed CPI, I might also very well go over trimmed simultaneously to understand all of this as well. But I've gone through, like I said, in you know, through in the video what it represents. But nevertheless, I think this is going to be a little bit of an extraordinary call / video, so you'll definitely like it. Trimmed simply represents the average, so it's simply the monthly average. So it's I think it's the 3-month average of CPI, etc., etc., of the things you're measuring, And so we see CPI year-over-year core CPI is essentially at 3% currently, which means that the underlying things is more or less at 3%. What the consumer right now is feeling is 3% inflation. PCE, which is desired, remember this is pretty much what the Fed is looking at. Do you also look at month on month? Not really. This is month on month. Like, this is aggregated into the month on month, since of course we look at month on month, but month on month, it's on its own, it's not really that important. But if you plot all of the month on month, then you get a year on year. So this is the same thing, right? But month on month does not really show us anything. I know them in and out. You can see this is the month on month right here. This is the month on month. This is the month on month. This is the month on month. But looking at them in trend, this is where you get a little bit more of an edge, since then you can look at if they're going up on a month-on-month basis, right? See, that's where it is. But of course, I look on a month-on-month. But year-on-year simply means the same thing. It's just you plot all of these month-on-months on a year chart. Okay, so that's simply what it represents. So you can see them right here. Now, of course, we're not going to go over all of this like this. That would be too messy. So we're going to break it down a little bit. And so, first of all, I just wanted to focus a little bit more on the more volatile goods. So I just wanted to go a little bit more and focus on, for example, services, less energy services, food away from home, food at home, energy commodities, and commodities, less food, energy commodities. This is pretty much what I'm going to focus on, since all of these, I would say, is pretty much of relative importance, and which is usually the things which changes the inflation pretty much the most. And so you can see this is over the month percentage change. So this is how much they change on a month on month basis, and this is how much they change on a year on year basis. And you see energy commodities is what had pretty much pushed up the latest CPI report right here, as you can see. And this is for the September 2025, by the way. So you can see the energy commodities is what has risen the most. Okay. But it's less of an importance. Okay, what's more of an importance is the year-on-year percentage change, because this is essentially what we can see. Energy services, which has gone down, like you can see, month-on-month change has gone down, but year-on-year change has gone up, which is a very good thing, because this could be a lead indicator for this to go down. Nevertheless, how big the circles is here, the dots or the bubbles is, this is a bubble chart it's called, is that of their relevance importance. So of course, services and less energy services, this is one of the most important sectors. Okay, and you see it has gone down, but has overall gone up on a year-on-year percentage change. So it has gone up a little bit, but on a monthly change it has gone up slightly. As you can see, it's a 0.3% increase, but year on year it's up much more. which is we want all of them to trend this way. So we want all of them to trend this way. We want the dots to be here. So you can see this is the all items 3%, and this is like the equilibrium. You can see this is what these lines represents, and where you find this is in the BLS. So I look at this as well when I go a little bit more in depth, since it's quite good representation. It's quite good depiction of where different items and different services are heading, goods and services, right, are heading, to grasp where the more volatile items is in terms of their inflation, right? So we want them to go here, because this is where we see disinflation. Here we see inflation, right? On a different proportion, but here we want them to be in this corner, right? Nevertheless, focusing on the truthflation inflation index, you can see has continued collapsing, which is a very, very good thing. This is nevertheless also a leading indicator. Now I've talked about essentially different components going down, and they're down like crazy. Now this is of course pretty much day on day adjusted. So this is day on day updated. You can see year on year change updated daily, right? And this pretty much is our main forecaster for inflation. Of course, we're using PPI 2-month lead on CPI as well, and we're using, you know, M2 money supply lead on inflation as well. But this is one of our primary tools, okay, in our toolkit for us to look at what pretty much the BLS is, next to report in terms of inflation rate, CPI rate. And you can see right down in here, this is pretty much the average division year on year, and this is the overall average division, which is 0.07. It has only been out since 2023, so it's a quite new tool. Nevertheless, it's one of the most, I would say, it's one of the tools which gives me the most edge, I would say, because this literally tells me what the CPI is going to be before the CPI releases. And I would say, because, you know, this is the average, but you can see it's the average since May, and now they have been a little bit, higher of a difference, because here it came out, for example, this was the latest, this was a September. You can see September here for them was approximately 2.4, as you can see, and then we came out at the 3. So you can see it's like a 0.5% division, I would say, currently at the moment. Now this truthflation is much more accurate than the BLS reportatives, okay? So this is much less less of an inaccurate tool. This is much more of an accurate. It is one of the most accurate tools there is. This is, one of the tools which major institutions is currently using right now, to give them a lead on inflation, etc. And so you can see that inflation is currently sitting in the US at 2.32, which is crazy close to the 2% target. And I think soon enough, give it 3 or 4 years, because as I talked about, the bureaucracy is very slow turning real. The Fed will actually, just cut off BLS. We will not have any more BLS. Rather, we'll have these blockchain data, which we'll get in and gonna measure much more, individual services and goods, to get this much more depicted, much more highly precise inflation read, rather than this BLS report, which only takes in consideration 70,000 goods and services. This through inflation takes into consideration 13 million, which is more than, I would say, 13x more the accurate this is. This is 13x more accurate than the BLS reported. Nevertheless, they will have some divisions, and I think there will be like a 0.5% division. Nevertheless, we're expecting CPI to go down. So we're expecting CPI to come out at 2.7 or something like that, 2.71 or something like that, 2.72. And how do I get that number? Well, that pretty much goes in detail, specifically is forecasted by my other leading indicator, which is PPI 2-month lead on CPI, which is essentially what we're gonna go into. Now, what this all means, I'm sorry for just going ahead of myself, is that monetary policy will loosen. So we got a less restrictive monetary policy in the long run. As I talked about, even if the Fed do not want to cut at the moment, they'll be forced to cut in the future, because the data will suggest they need to cut. So, but nevertheless, there will not going to be any, crazy craziness going on since the Fed, nevertheless is going to cut. Okay, and we know, because we know how the Fed board will look like 2026, come 2026, and there will be majority of them at least dovish members. So think about that as well. And we're going to talk about the monetary policy afterwards, but of course we're going to focus on the inflation, labor, and then monetary policy. Now, how do I get to 2.72? Remember I said that? Well, that pretty much I get from this 2-month lead PPI on CPI. And you can see this is pretty much the November 2025. This is the latest report. This is the, of course, month on month. But nevertheless, this is aggregated into this year on year PPI. And you can see it says it's 2.72. And you can see how well actually this follows or is a lead on CPI. CPI is of course always a little bit, I would say, higher or lower. Now, usually you can see that PPI has indeed actually been higher the last couple of reports than the CPI, which means that we might even get a little bit lower than this. But this is what I would say my max forecast is for CPI. Listen how accurate this freaking is. And my lowest, because I have a low and I have a high forecast, and my low is 2.32. So I'm looking at a CPI between 2.72 and 2.32, which essentially is lower than the reported and forecasted 3.2%. So institutions right now is pricing in a 3.2% inflation rate. 3.2, you heard it. Well, not me. I'm pricing in between a 2.72 and a 2.32 inflation rate, CPI. Okay, listen, that's much lower than previously forecasted. And if we indeed get that, well, what's going to happen to the monetary policy? Well, wait until we get to that monetary policy part of that call. Now you might pretty much start understanding where we're heading now, since we're very close in accordance to the 2.32 inflation to inflation read to the 2% target. Then major institutions has priced in. They think we're at 3% currently, 3.2 or something like that, forecasted in accordance to Bloomberg's aggregate or something like that. I think they're way off, and I think what they should be focusing on is the second mandate, the unemployment rate, and the unemployment rate ticking up. Nevertheless, you can see essentially we are looking at, since when we saw inflation rising up, we saw pretty much DXY going from like 80 to above 110. Okay, and we're watching that 80 line here again. So we're watching DXY dollar strength diminishing again by, let's say, 5% year on year. So next year we're looking at the DX dollar strength being 5% lower. So we're looking at being at 80, which means our long-term trend is lower. And that's of course in accordance to that we think interest rates will go to near zero levels, since inflation will definitely not pose a problem with this technology boom. Whenever we have gotten a technology boom, like for example the industrial revolution and all that. Now we're not looking at like industrial revolution, but we're talking about an equivalence of the internet. Like AI is an equivalence to internet, right? We got the deflation, and we got the deflation for multiple different years, and then inflation went from literally 3% to like 1% or something like that, and it stayed there for a long time because we got this production as services boom in the economy, which is essentially where all the velocity of money went. So now we got more jobs, less unemployment, and less of this velocity more or less being delivered to inflation, and more into goods and services being produced by an economy, meaning higher GDP growth, which is essentially what we're looking at right now. So, hopefully I understand all this, which means that 0% interest rate, that's what we're looking at. And that's of course not priced in at all by these institutions. They think it's going to go to a neutral level and stay at a neutral level. I think they're completely stupid, and I think they're going to go to a 0% interest rate. Which means that then they can start quantitative easing. So that's what I think will happen. Now, focusing on all of these different things. Now, of course, we're not going to go into all these different things, but if you actually load up micro, which I definitely recommend, you can go in and check all this. These are the individual tools I use, and I think all these are crazy good. So you can see ranging from US challenger job cuts, the US beverage curve, which is one of our main measurements, the labor force participant rate, versus foreign-born workforce, initial continuing jobless claims, unemployment trend index, real labor productivity, ASA staffing index, business application monthly, non-farm payroll versus temporary health services versus GDP. All of these are crazy good tools, and the macro tools I use to look at pretty much the unemployment, which is essentially what I'm gonna go over. So I've pretty much put them all together, and I'm gonna create, an indicator for this as well for you guys, but more of a quantitative indicator, which puts all this into takes all this into consideration. So this is what I'm currently working on. And remember, we're gonna have the unemployment part because we have had, remember, the inflation part, first initial mandate of the Federal Reserve, price stability, and now we're gonna have a second call, which is tomorrow, about unemployment. So there you'll learn everything about unemployment, forecasters for unemployment. They're gonna go over everything you need, and then I'm gonna also release an indicator for that, like I've done for inflation now. So you're gonna get everything for you guys provided. Don't worry about it. But I would say if you don't have it, and if you want to focus a little bit more on the unemployment side of the economy, you should go into Macro, because they have such good tools in their toolkit or arsenal, whatever you want to call them. Here's one of them, for example. This is essentially one of the tools I use, and this is like technical analysis, fundamental analysis, and macro analysis. This is simply the same thing as technical analysis. You cannot focus on all of them at once. Now it's a little bit different because you actually can focus on majority of them at once, because usually they show in the same things because they're using the same quantitative information, the same macroeconomic data. Technical analysis does not really do that because you get a lot of different results. So I'm sorry about that, but nevertheless, right, usually at least focusing on a few select says, otherwise you'll get overwhelmed. Okay, so focusing on a few, I'll show you mine right here. I focus in on non-farm payrolls versus unemployment rates. This is one of the best tools. Whenever we see unemployment, or non-farm payroll fall, which is of course a leading indicator for unemployment, we see unemployment rise. So we can take this, for example, in the late 70s. You can see non-farm payroll went into the negatives, and of course that caused unemployment to rise. So these two are not correlated, they're indirectly correlated. Non-farm payroll means how much jobs is getting created / not getting created. Unemployment simply means how much people are employed. Whenever we see recessions, you can see we usually start seeing non-farm payroll falling, to when we see the recession, unemployment rising. So unemployment is the last thing that happens, and usually unemployment is not what you should look at if you're a trader, because unemployment is a very late cycle indicator. That's what happens when we have already gotten into a recession. Nevertheless, all the other tools like non-farm payroll is what you realistically should focus on as a trader, since that predicts if we're gonna have essentially a higher unemployment and all that. Okay, so that's pretty much crazy important. So you can see same thing goes here, same thing goes in the 80s, in the 90s, in the 2000, leading up to 2008. You can see non-farm payroll went down. 2010s, non-farm payroll went down, unemployment rose. So unemployment is this red line, and non-farm payroll is this blue aggregate, as you can see right here. Same thing now, we have seen falling non-farm payrolls, and as I said, this is a problem. This is why the Fed, why are they so stupid? Why are they not cutting interest rates? This is what I think, and I don't think they're stupid indeed. So why am I saying they're stupid? Well, because they're being pretty hawkish. I think Powell is late now. He needs to cut. If he does not cut, this is where we face a problem. This is where my portfolio will most likely hit a very hard punch, I would say, because this is when my full on risk on shit falls. Okay, but nevertheless, I look into all of this, I focus in all of this, and I pretty much analyze all this. So this is my research. I think they're gonna cut because I think they're smart enough to focus on this. Because if you can see, whenever we go into negative, we usually see fast recession and unemployment rise, and whenever unemployment rises, that's when the market is cooked. This is of course the ADP non-farm payroll, which is of course not delivered by any government like, what is the difference? Because I've heard some people talk about non-farm payroll, and I was good to cover this of course when we talk about unemployment and everything about unemployment side. More or less maximum employment, the second mandate, right, of the Fed. But nevertheless, I've gotten a lot of questions like, what is the difference between non-farm payroll and ADP non-farm payroll? Well, ADP non-farm payroll is focusing just on the private sector. It's not focusing on essentially the public sector. So it's not focusing on the government, etc., etc., government jobs and all inequalities to governments, which is what the which is just what the normal non-farm payroll does. Because the normal non-farm payroll, like the one called NFP, simply focuses in on all given jobs in an economy, and is of course made by the BLS, while the ADP non-farm employment focuses on just the private sector, which essentially is just all companies, etc., etc. So yeah, and it's non-government funded, so that's why you get an ADP, but you don't get a non-farm payroll, and the government, for example, is shut down as you experience. So we got an ADP, but an ADP is also a leading indicator for non-farm payroll. And actually, the latest reports we've gotten, because we've gotten it when the government has been shut down, so we're looking at this information as well. You can see it has been negative, actually. Not crazy negative, but it has been non-creation at all. So it has been negative to like little to no change. Okay, so that's a little bit worrying. This is why I think the Fed needs to cut now, and as long as the Fed cuts and we get these potential liquidity injections sooner than later, we're good to go. Now the labor market index, this is just an index Macro has done. You can see it's going lower, and of course whenever we see, for example, the labor index completely collapse like this, for example, then of course you see prolonged drawdowns in the markets, and you can see this is why this period right here was just incomplete, and this, of course, this is what I'm gonna create, by the way, for you guys. So I'm gonna create something like this for you guys, indicator taking into consideration all things like unemployment, non-farm payroll, now initial jobless claims, etc., etc. I'm gonna create some quantitative tool like this for you guys tomorrow, but it's gonna take some figuring, okay? So don't worry about that. Now let's turn ourselves to monetary policy. Focus it in on the Fed's two mandates, which is what we have covered pretty extensively. We can pretty clearly say and state that ultimately what we are looking for is simply rate cuts. Now, the importance here, of course, is that we see a rate cut in December. Otherwise, the market will, of course, continue down lower. We're talking about stock indices, and dollar strength will continue up higher. Remember, we're also in a bet against dollar strength because we're in Euro USD longs. Remember that as well. So what we want is more or less this rate cut in December, because essentially it's priced in. So nothing will happen if we indeed see a rate cut. But if we not see a rate cut, because it's priced in, the rate cuts, right? So the rate cut is currently priced into the markets. It will unwind, meaning that we'll see big changes in market structure. Meaning that essentially, if we not see a rate cut, or we see this odds shift a little bit, we're gonna see a euro fall in. We're gonna see stock market fall in. Okay, that's essentially what's gonna happen if we don't see a rate cut. Now, that's also going to diminish the probabilities for a rate cut in the future, which is going to completely screw over me, okay? Now, in accordance to my research, I think it's pretty obvious that they will cut. Now, the important part here is nevertheless not that they're going to cut in December, because it's pretty obvious that they're going to cut in December in accordance to everybody else as well, but what they're going to do in the future. And in the future, you can see the odds right here is not favoring a rate cut, okay? So you can see people believing that if we don't see a rate cut here in December, you can see here 350 to 375, we'll most likely see it in January 28th, okay, 28th of January. But what I think is that we are going to get a rate cut here and here. You can see here and continuing 8th of March, 29th of April, 17th of June, 29th of July, 16th of September. The rate cut probability odds is skewed, meaning they're in a normal distribution, okay? So they're well, most likely going to be a neutral, something like that, following just what the Fed expects. I think they're all stupid, because I think they're going to get 25 base point cut, 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 25, and going on into the future until we're at near 0% interest rate. Now, we have talked about the two Fed mandates, but here's when they really come into play. Remember that we think they've already more or less hit their target of 2% inflation. We have a 2.36% inflation rate, talking about the more precise. But we at least have, lower CPI than we have currently, which means that inflation has at least gone lower in accordance to the BLS measurements as well. That's what I price in, at least. In accordance to me, I think that's going to happen. Now, as we talked about, the NFP being a leading indicator for non-farm payroll, being a leading indicator, for unemployment, has put the Fed at risk. So they need to start cutting, because they need to start more or less focusing on the more consumer, the normal consumer of the economy, which we can see have been completely pounded. I think maybe I put it in here. No, I didn't know. And so I think they need to support that, which I think they will do. So I think they're smart enough to actually do that. And if they're not smart enough to do that, they'll be punished through extremely low inflation rates and extremely high unemployment, which will force them to go to zero quickly. And that would also, of course, be a hard landing, because they will experience a recession. Remember what I said here. This is pretty explicit. If we don't see rate cuts now, we're going to see a recession. If we see rate cuts, 25 basis point, 25 basis point, 25 basis point, we'll avoid a recession and we'll hit a soft landing. This is what you should be focusing on currently. Note this down. It's important. Let's go into the other tools and mechanism the Fed has at its disposal and see what it has done. Now, focusing on, for example, the recent Fed balance sheet, you can see essentially that ultimately, you can see nothing real has happened. Now, what they have previously said is that they're going to stop quantitative tightening. They're going to stop the destruction of money. More or less that, they're going to at least stop taking money out of the system and at least pretty much have it as a neutral level. Now, I personally think so as well. And they're most likely, like, whenever they have stopped quantitative tightening, as you can see here, late 2012, late 2009 here as well. And of course, 2020 here, they've always, gone into a hard landing and need to start this quantitative easing. I think this quantitative easing will start eventually, meaning they're gonna purchase securities, etc. That I don't think we're gonna hit a hard landing, which means that we eventually are gonna get this liquidity injections by the Fed. But that's when we get to the near low 0% interest rates. This also goes into me not thinking we're gonna hit a hard landing like we've hit the other times, which have pretty much made the purchases of the securities more likely. But we already have some quantitative easing in the system because the Fed owns more than 6 million securities. You can see this is 5 million here, 6 million. They own, nearly like 7 million securities here already, and now they're stopping. Now, when they start the quantitative easing here, there will be a gradual cycle, I would say. So just keep your, your eyes on the Fed balance sheet, since we need to start seeing when they're stopping completely, which is December the 1st. They would say they're going to stop, so they'll stop right now. And then they're going to eventually, you're going to be stable here for a while, like this, for example. You're going to look at this, for a while. And then we're going to start, purchases when we go into that, in the future, like 1-2 years, we're going to see, potential for quantitative easing to start again, when we have seen the money mutual fund run out of money and the company cap expenditure run out of money, which is also what we're going to focus on. Now, let's just go into second underlying dynamic. But before that, I just wanted to ask you guys if you have any questions about the first underlying dynamic, the macro analysis. I know I focused just purely on the US today. I was to focus a little bit more on Europe and Japan and other countries, but nothing really has happened. Nothing really that would change my mind about what their monetary policy would look like. One thing that goes for England or the UK. Now, I think the BOE, the Bank of England, is gonna cut indeed. Next time, which is now in December, they're gonna cut. BOE is gonna cut. Now, what's gonna happen to GBP USD and what's gonna happen to Euro USD? Because this will also, of course, impact the cross correlation of assets, like this for the exchange rates. Most likely, I do think that they're gonna also talk about quantitative easing, which is gonna put downwards pressure on the gilts, okay, which is actually gonna put upwards pressure on GBP USD, which is going to put upwards pressure on Euro USD. So that's bullish, even though it's counterintuitive to think about it, okay? But I think it's short-term bullish for GBP USD and Euro USD, and long-term bearish for them, okay? Understand me, everybody? Any questions there as well before we move on? And no questions about monetary policy? Okay, no questions. Okay, so let's just then move on. So let's just go over the cyclical stages. Let's just go over essentially the second underlying dynamics, and we're actually going to start off a little bit differently here, because we're going to actually start off with the business cycles, and then we're going to go into yield curves and inverse yield curve and all that, and of course sentiment reports and all that as well. First of all, what I want to focus on, and this is not something I've shown previously, that's pretty much the conference board. The conference board is more or less an non-government organization, an NGO, which essentially specializing in economics. It's like an, what is it called? Let's see if I actually remember what they are called. Think tank. It's a think tank. Yes, I want to also create a think tank, by the way, but I'm not going to go off the rails here. Nevertheless, it's a think tank which essentially focuses on economics. Now, they're composed, and it's some quantitative measurements or something like that, leading indicators for the business cycles. And whenever you see these three, pretty much going down, so you can see when you see in this leading indicator, for example, starting to go down, and then you see the constant index go down, then you see a recession. Okay, now what I want to show you is that essentially we see an underlying economy, meaning the leading index, which is essentially going through the underlying economy. Okay, it's going shit, as you can see, and that's exactly what we want to see. Okay, why do we want to see this? Well, because this puts a lot of uncertainty on the stock market, which is essentially what has caused this dip today. But people are more focused on the uncertainty than the long-term prospects, because the long-term prospect is that this is going to reverse, and this is like the first time in history we've seen something like this, where the leading indicator has not led to a recession. As you can see, they're going down to shit. We're like below the 2020 levels here of a conference board, of the leading indicator conference board. So the leading index here, while ultimately you can see it's slowly, you can see here it was steepened, and here is slowly slowed down. So we're more or less at the end stages of this. Plus, we've not seen a recession. Now, what is causing this? This is the capex. This is the AI revolution, which is in the first time in history not causing a recession, and not stopping this things, which is essentially this, which is the confidence index, and the other, which is the lagging index, to go down. Nevertheless, okay, lagging index is of course unemployment, and more unemployment focused, as that unemployment is more lagging. That's just what I think, because this is confident information here. Nevertheless, I think this is essentially what all institutions is missing, and why I think this is our edge. Like, this is our opportunity to go in and take part of this. Of course, it's a high opportunity, but it's also a very high risk on this. Now, of course, we have the consumer sentiment as well, which is of course what we need to focus on. Now, I've talked about this a lot. I'm just going to mention it because it's just such an important part of our second underlying dynamics for the indices stock markets. And that's just because that has gone down like crazy. We're below the Great Depression levels of consumer sentiment. Nevertheless, you can see we usually reverse on these levels between 50 and 40. This is usually like 90% probability of reversal. And when this reverses, this just means that essentially the consumer is becoming stronger. And this is nevertheless when we have this low interest rates. So if we see interest rate going lower, consumers should be better and happier and being able to spend more, which is going to cause the AI spenders to earn more money and be able to spend more, which is going to lead to the AI infrastructure players to get more deals and get more money and get their EBITDA up and get their stock price up and get the AI implementers and pretty much creating this bubble and making it bigger. That's what essentially is going to happen. This is what we're looking at. So you can see here, what I said, 90% probability below here. I've done my research. Gonna probably see a reversal. Every time in a recession, we usually see this low. This is also the second thing we want to focus on. So usually, when in the recessions, we usually see, this go crazy low. 2025, we have gone crazy low, but we've not seen any technical recession, which means either we reverse here and have a mega cycle, or we just continue dumping. And we have never done this in history, and I'm betting with history that we're gonna reverse here. So Maybe, of course, we could have an exception and consumer sentiment could go like further to like 30s and 20s and all that. But that's never happened in history. And I'm betting on a reversal here because I'm betting on lower interest rates and the Fed actually stepping in to help the average people. Yield spreads into consideration, them pretty much being lower now and going ultimately much lower here. You can see they're closing down lower. You can see the USD attractiveness levels has gone down. And as I said, this is the only major indicator we actually need for us to be comfortable seeing lower dollar strength. Actually, and very good, some very good insight, okay? Some very good, like, not macro insight, but like pretty much sentiment and flow insight. So when people don't really know what they're afraid of, so when there's not really one specific thing which is in the focus, in the spotlight of the media, so for example, people don't really understand why we're seeing these dips in the markets, then usually these dips are nonsensical, then they're stupid dips, okay? So for example, now this dip was caused by multiple different things in the quote toss. This was ultimately caused by outflows. This was caused by insider selling. This was caused by a correction. Insiders wanted correction in markets to buy more. Institutions wanted correction in markets to buy more. That's like the deep side of things. But the more public side of things was that this dip was just because of a growth scare. This was just because of pretty much fears of a recession coming through with unemployment rising. This was also due to the AI, bubble fears, essentially, etc., etc. So it was because a lot of things, but none of the things actually had data backing them. Like none of the things here indeed had like backing of like real data of like non some economic number or anything like that. Okay, and that's what caused this dip in essential. Okay, this is why this dip was not really a dip worth focusing on, and rather a dip to buy, okay? But when you have, for example, let's say unemployment go crazy because of non-farm payroll forecasting, like a recession or anything like that, and all the media is focusing on we're gonna have a recession, then it's worth looking into as long as it has data backing. Nevertheless, you're gonna know long before the media if we're gonna have a recession or not. Thanks to that you actually know macroeconomics. So, but that's just like one tip for you guys. Nevertheless, retailers, this is, as I said, a gauge on the emotion in the markets, aka which has the most emotions, retailers. So this is gauge of what is retailers doing, and since retailers is usually selling the dips and buying the tops, this is essentially the forecaster for it. So this is essentially just telling us that retailers is panic selling currently still, which means that we're most likely gonna go to an optimize, and then in optimize this is gonna change to neutral or something like that. But if you look at a timeline, so if you go into the timeline here, you can see that we essentially had extreme fear April the 7th, and April the 7th we actually had intrinsic details of why the markets actually went down, and that was just because we had tariffs. And then, yes, if the tariffs was to be implemented at its full, so if we wouldn't have these trade deals and all that, then of course we would go into a worldwide recession, and then of course it would make sense for the market to dip like this. But now this fear, because you can see fear has slowly crept down, as you can see, like over the past few months, has no real reason, and this is just retailers being fools, okay? But this was pretty much sensical. This is nonsensical. But here you can see May, for example. May essentially was looking at the timeline here. See, May was very bullish. September, October, let's see what they did. July, what was July? See, this was pretty much when we were new optimized. This is when retail is getting like extreme greed. This is when they're buying. So they're buying the tops. As you can see, they're buying the tops and they're literally selling the bottoms. So, this is very good gauge on what the retailer is doing, the retail sentiment and all that, which is a very good thing. Nevertheless, here you have option walls, which is a very good thing as well, but I'm not really going to cover it. As you can see, this is for QQQ. You can see we have pretty much started seeing the 20-day rolling day positions stagnating, but where my real focus is on the major inflows at the bottoms here. You can see the major inflows, which means that as long as we go higher here of the net 20-day rolling day positions, I think we're good to go higher for stock indices. Okay, and that goes for S&P 500 and Dow Jones itself as well. Now, looking at, for example, SPY, S&P 500, you can see that we have also started seeing net inflows, some outflows, but now majority of them is net inflows. But we have seen this essentially course correct, and we have gone even lower for the net 20-day rolling day positions. And I would like this to course correct and go up higher for me to be comfortable to see new all-time highs and not focusing on levels. Now, what do I do in this situation where we're not started going higher yet on net 20-day rolling day positions, but we're still seeing net inflows? Well, then I go in for net inflows, okay, on a day-to-day basis, remember. But if this continues lower, like the next day or the next day or the next day, then that causes me to look at the high levels. So that causes me to look at the standard deviation daily 4-hour levels of an extreme high. Because usually that's when, if we hit those levels, where we see continued dips. Okay? Is it clear? Because that's essentially how I look at things. So as long as we see net inflows here, and we don't see new low lows here of the net 20-day rolling position, and we slow down with the momentum downwards, I'm going to see upwardsness. But if we see this getting broken, I'm focusing on the higher time frame levels, standard deviation levels of the technical analysis. Triple QQQ, we'll see what it does. I don't know, this is some, I don't know what this, sharp decline happened, as I talked about. But the net 20-day roll day positions has declined slightly. Nevertheless, that was to be expected. But what I'm focusing on is the inflows here, and they're looking net positive. So that's a very good thing. So yeah. But I think QQQ is the most reliable here. Let's just a little bit look at seasonalities as well. But we'll also look at the hedging of the commercials and large speculators. And you can see large speculators is just accelerating throughout this dip, while commercial hedging is also going through the roof here. That's to be expected. Open interest is just stagnated. Nothing real happens here. But what I'm specifically focusing in on here is more or less Nasdaq higher. You can see whenever we see this accelerate like crazy large speculators, this is usually after we've seen dips. They're buying the dips here, you can see here, and that's usually when we accelerate price towards upside. This is exactly what we're looking at here, acceleration towards upside. It's even hitting new highs here, I think, of a three-year high. So that's crazy. Dow Jones, the opposite is happening. We have a lot more shorts going on and a lot more hedging for lower prices, or for indeed higher prices. Russell 2000, you can see there's a lot more hedging here going on. So that looks like the large speculators are real focused in on Nasdaq. And S&P 500s, we're also seeing a little bit of hedging going on here as well. And I'll pretty much go through this deeper, send a little bit more deeper analysis, but I've gone through Nasdaq pretty deep. Let's go through seasonals of Nasdaq as well, and then we'll go through that asset. And you can see seasonals of Nasdaq usually is pretty much seeing that dip, which we have seen. This was pretty much the dip of mid-November, which we saw right here. And then we usually see some choppiness going on. This is seasonally, as you can see. And then we're seeing this Christmas rally towards the end of this year. And this is exactly what I'm looking at happening. And of course, then we're just seeing another rally until we see this seasonal tendency for lower prices here, which is of course where we saw the April tariffs coming through, aligning perfectly with this as well. Remember, nearly last year. But this is exactly what we're looking at. Russell 2000 usually recovers right now, and we're looking at a recovery for Russell 2000. S&P 500, we're going up, and the volatility index is usually pretty much going a little bit higher. However, if you look at S&P 500 and Nasdaq, think that we have seen all this volatility is past us, and that we're now going lower for volatility and all that. And now we're pretty much going to go to higher prices. For Nasdaq, like what this specifically means for Nasdaq, we'll pretty much go in and focus in on Nasdaq now. What all this simply means in simple terms is that we are looking for Nasdaq going to new all-time highs. That's saying, if we see net 20-day rolling day positions, I would be focusing in on these key levels like this, for example, and like the weekly level, for example, this right there. So then I would be focusing on this weekly level, this daily level extreme, and this 4-hour level extreme, like this for extremes. But for now, at least, I'm more or less focusing in on a little bit more technical, since I know we're going to go to new all-time highs. I'm simply on a day-to-day basis going to take technical STAs, which essentially looks at a dip of equal lows or anything like that, and simply looking at highs. So like, for example, this right here, I'm simply going to focus in on us going through an extreme low level or any 1-hour levels, like for example, or any 50-minute level low extremes. You can see like this, for example, and essentially buy from there. Now, what I'm expecting the market open to be at is actually indeed open a little bit higher, and that's just because crypto this entire week has gone higher, which means that I'm focusing in on Nasdaq actually going a little bit higher. Hopefully all of this makes sense. So it's going to probably gap up higher a little bit, but then I would not be surprised if we indeed see pretty much us going here, and then us seeing somewhat of a dip, and then ultimately us recovering. So I'm just simply looking at, on each and every day, higher prices. Okay, so I'm going to be bullish. I'm going to focus on bullish STAs, but I'm looking for me to take these bullish STAs. We want to go to these like 5 very extreme low levels like this, for example, which if we indeed open up higher here, gap down, and then pretty much take all this, which I think it might actually do, I'm looking for an ST like this. But this is nevertheless highly unlikely for us to see like all this pullback down here. Rather, I would say gap up higher, a little bit of a pullback, and then higher prices. That's what I would say, because price is nevertheless crazy bullish. And the sentiment from here is most likely just going to be even more bullish for indices. All this makes sense? Hopefully at least. Let's just continue, and let's just actually focus in on a little bit of the big things, okay? The dollar strength, which is most important thing, because this is what we're focusing on significantly. Now, for the dollar strength, as you can see, COT has indeed updated 14th of October. We're getting a little bit delayed out still, but the hedging is continuing. Like the long-term program here, and the hedging is continuing. We're looking for indeed a long-term program. So we're looking at something like this. So we're looking at continued acceleration for downwards pressure for DXY, and institutions, these large speculators, focusing in on a lower DXY, which is exactly what we want. We want this lower trend. And that's exactly what we're going to get when interest rates is trending, and when inflation and all that is trending and moving, right? Same thing goes for Euro. We are, of course, looking at a long-term program here, and we're, of course, looking at something like this happening, where, of course, we're going to see long-term higher prices for the Euro, reaching its new highs, and pretty much going higher from there. For GBP, it's looking much more consolidated. So we're going to switch over towards the seasonal tendencies. And in accordance to the seasonal tendencies, US should weaken exactly as we think it will do. So seasonalities is perfectly aligned with us. Euro looks like it's going to strengthen, and that's exactly what we are looking for. GBP is pretty strange, and that's exactly what we are looking for. So we're looking at GBP USD being much more unpredictable than Euro USD. Going into specifically these individual assets, and what I'm focusing on them specifically, I'm more or less focusing on DXY going down lower over the past couple of weeks, since of course we're betting, and we of course have a swing trade for a lower DXY currently, or we're betting, we're having a buy on Euro, so then we need to see dollar strength weaken. Long-term price target is in the 80s, so even lower than this long-term price target. It's in the 80s here. It's in the 80s right there. Nevertheless, we are thinking we are currently breaking this daily level. So you can see regimes is bearish. For our regimes is also bearish. So what we are focusing on a day-to-day basis is pretty much simple STAs, like for short-term trades. So for example here, you can see this was quite a good STA. Here on Monday, we would just be looking at an STA. So I guess that's pretty self-explanatory. The levels I would be watching out for here is pretty simply, if this goes down, for example, to here, then I'll be having a level here. But I think that we might focus in on half of this and or this right there. But any of this might be significant. Nevertheless, I'm just watching for lower DXY. So we could, of course, also just see a spooling day tomorrow. So we're prepared for that. That's also a TP model. So that's TP model work. And then we might see something like this. If this goes like, for example, remember this might move to here, for example. Now we might see an STA like this on the Tuesday. So that's something we might see on the Tuesday. Nevertheless, I'm just focusing on a lower DXY. And that's just, I don't really know how the candles will print. But I suspect that we're going to go lower. So just watch out for STAs or TP models. Same thing goes for Euro. We're just watching for a higher Euro nevertheless, as we are also in a bet for a higher Euro strength. So I will be watching 1 hour and 4 hour levels here. Same as I'm doing for the DXY. where I'm focusing in on higher levels. Of course, we have a higher level here as well, by the way. So price could go all the way up here, and then we might see a reversal since we have a lot of liquidity resting up there as well. But that's the last level, and then we usually fails. So we gotta see, and then we might run higher as well. So anything is a possibility. If we did run higher, that would be a good thing. That's not a bad thing at all, because then we go against fundamentals, and then we just have a long run down, which means more opportunities towards down. And that's why most likely we don't really want to see a setup here on Monday. Rather, it would be better if we see a confirmation setup on the Tuesday after Monday closed bearish. So that's essentially what we're focusing on. You can see GBP and EU is a little bit decoupled, but GU looks a little bit bullish. Why we saw this crazy bullishness and this crazy good STA. Remember this STA right there? I'd like totally missed this. This was like the level I had, and this came from like this 1 hour level you can see right there. Was because of the gilts and the new government policies, so geoeconomics policies for the UK, which pushed down gilts and ultimately put upwards pressure on GBP USD because they rebounded to its equilibrium with the gilts. Okay, so realistically, GU should be much higher because its gilts are even higher than US yields, right? So if you look at spreads, you see spreads is much higher or much lower compared to US. So if you look at this, for example, they're much lower compared to the US EU spreads. Okay. Now, what am I looking for? Well, as I said, I'm not really focusing on GU at the moment. I'm focusing on EU and Nasdaq, and so these are the two focus pairs. But I would just be focusing on buys. So if you're trading GU, I would just be focusing on buys. UJ, I would be focusing in on a little bit of sells. To be fair, to be honest. And I talked about that. I don't really necessarily think that there will have any hikes in the Japanese markets or any in like BOJ hiking, and that's just because I expect Taikeichi to reject the hikes. Okay, so that's potential for what to come. Now I think that's literally it.